Okay, everybody, welcome to Module 2 of our live education program. This module is entitled Technical Analysis for Day Trading, Part 1. Right now, if you guys are active in the chat room, please let me know by typing yes so I can see who is here with us right now. Yes, thank you, Luke. Thank you for joining us. Eric, if you're here, please type yes. Khalid, if you can hear me, please type yes. Rohit, if you are here, please type yes or say something in the microphones. Let me know you guys are here. If not, that's okay. You guys can get the recording for this session after it is done. But either way, we are going to be moving forward. Today's module is a lengthy one. We have 72 slides to go through, so I do not want to waste any time. We are going to be building upon the knowledge that we gained from the previous class, and we are going to be moving forward from here. Okay, so moving on. On today's agenda, we are going to be covering candlestick charts. We are going to be understanding candles, the anatomies of Japanese candles and whatnot. We are going to be looking at understanding support and resistance, which is absolutely key when it comes to trading the markets on any time frame. And then also we're going to be looking at markets in the terms of uptrends, downtrends, and range-bound markets. We will also continue to build upon this last point here when we talk about market profile and how you can anticipate what type of day you're expected to see. In addition to that, we will also build upon this last point when we talk about trade setups in the fourth module, I believe, fourth or fifth module, I believe, when we talk about setting up trades with optimal risk reward. It is all building upon our knowledge of understanding what type of day we can expect from the markets and how to position ourselves to capitalize from the markets with the most optimal risk reward. As always, guys, if you have any questions, please feel free to just interrupt me by speaking to the microphone or type into the chat box, and I'd be more than happy to answer your questions. If you guys don't respond, I'm just going to assume that you don't have any questions and just move forward from there. So moving on, charts. So there are many types of charts that are available for trading, as I'm sure many of you have known. Charts will typically display information related to price, time, and volume. From the chart types that we have, there are many, many different chart types.
You are now muted. You are now unmuted.
Excuse me there. Said cough for a minute. Anyways, so there are many, many different types of chart types. You have the typical line charts. You have the stick charts that represents the open, high, low, opening and closing. In addition to that, you also have the candlestick charts, which is probably the most popular form of charting analysis available. We also have Renko charts, Hakanashi charts, and many, many more. For our purpose only, we are going to be dealing with the basic Japanese candlestick charts. The reason being is because it's very common and it's very easy to understand. It provides us with a lot of information and it's more useful for us from a day trading's perspective. Always, always, always from a day trading's perspective, we are going to be using the information that we attain from the candlestick charts and the patterns and whatnot and overlaying it with the Toro Challenge rules to give us the highest possible chance of succeeding within the challenge. So for this intensive purposes, we will be focusing on Japanese candlestick charts primarily. That's not to say that you can't use other charts, line charts, Renko charts, etc., for your own personal trading. But for day trading, we feel that it's most optimal to use this particular charts. Again, FYI, if you have an investment perspective and you wish to look at larger time frames, some of these other charts may be applicable and some of them may be very well suited for your style of trading. But for our purpose, again, Japanese candlestick charts will be the ones that we're going. So here we are. Here is an example of a Japanese candlestick chart. And as you guys can see here, this is very, very common within the trading world. Even over here, you can see we have an example of charts over here that you guys can take a look at. Right, these all here represent candles. All of this information here represents candles that we can take a look at within the charts, and it provides us with a lot of information. For example, when we take a look at gap zones as a price gaps, this is what we refer to as a gap, where the price opens at the bottom yellow line and then it gaps up here. Right? This is an example of a gap chart on the S&P 500. Each candle here represents a time frame in which we choose. In this particular case, because this chart is set to 1 minute, this essentially means that each one of these candles represent a 1 minute time frame within this trading period here. So within this trading period here that we see, all of these candles represent 1 minute of action, 1 minute of volume that's taking place in which the prices fluctuate from up and down. So here is a candlestick anatomy. So green candles represent that the price has been moving upwards and that the closing price is higher than from where it opened. So as we can see here in this particular area, this here is referred to as a wick, right? These here, you can have an upper wick and a lower wick. So the upper wick and the lower wick essentially represents where the price has traded in relations to where it has opened and where it's closed. So the lowest price has been reached since the opening, and the highest price has reached since the closing represents the wicks. The body of the candle is where you see the opening price. So let's say if we had the price here that has opened somewhere around here, and we can just give this an arbitrary number of, for example, $10, and we can see that the price opened here, and the price reached an all-time high for this particular candle, and we can refer to this price as $13, for example. So that this time frame for this candle, the price opened at $10, it reached a high price of $13, and then this time candle stamp closed here, and we can say this closed at $12. So the 10 to $12 would essentially represent the body. The wicks would represent the highs, in this case the $13, and here we can also give this a number here and say this represented the low of $8. So in this particular candle, we can see information such as the absolute low was stated at $8, the absolute high was printed at $13, the market opened at $10, and then the market closed at $12. This represents a green candle represents the price going up, whereas the opposite takes place over here in the red candle. So everything that I've explained here in the green candle, the exact opposite takes place over here in the red candle. So you can see it's just vice versa, switching this information over from price action moving upwards to price actions moving downwards. So candlestick patterns, FYI, guys, they are subjected to interpretation. And so this is a very, very important point that you guys must absolutely understand is that the market is very open to interpretation. My interpretation may not be the same as your interpretation. So it becomes very important when we're looking at candlesticks and candlestick patterns and support and resistance levels, it is open to interpretation. Excuse me there. It's important you guys understand this fact that the market is all perception based. So what's your perception may not be the same as what is my perception. What we're trying to attain here is trying to see if the crowd effect takes place in which everybody is kind of seeing the same thing and everybody's hopping onto the same trade, pushing the price in the same direction. As the price moves in the same direction, that is when the price will be more likely to trend upwards or downwards. So it is very open to interpretation. Please, please, please keep that in mind. Okay, to increase our chances of having a successful interpretation, it is important to pair our technical patterns and candlesticks with other technical indicators, fundamentals, and things like that. In addition, it is more reliable when we look over a longer time frame. So I will talk a bit about analyzing time frames in the next module. So keep this point in mind. We will be moving to this point again in the future. Okay, so moving forward with understanding some basic handles. So the first basic handle that we're going to be looking at is referred to as a hammer. Uh, Hammers trade significantly lower when their price is lower than the opening. So this basically refers to the direction of the candle. So if we go over here, we can see that in a hammer pattern, the price is usually trending downwards. So when we see a pattern like this is typically indicative of a reversal. And it's more strongly when we see that it trades significantly lower than the opening price, right? It manages to rally later in the candle, closes above or near the opening price. It assumes existing downtrends, and it pertains to a bullish reversal pattern. So what this basically means is that if you have a chart that is trading within the markets, and let's say, for example, this here is where the market opened and the market moved up, and then the market moved downwards here. And right around here is when you begin to experience some hammer patterns when the market broke lower, right? This is a very strong sign that the market is going to reverse and come back, right? In market profile, we typically refer to this as a open drive reverse. In market types, we typically refer to this as a reversal market, right? So these types of things typically happen when we're looking for single candle signals. These are the signals that we're looking for a reversal pattern. So here is an example of Microsoft on a 1 day time frame, right? And so as we can see here, the market is typically moving in this direction here, and then we get our pattern here, and then that is a signal that the price is about to bounce, right? So this is very useful information from we're analyzing the charts from a daily time frame, and we want to get a sense of which direction the market is going to be going, and then from there we can essentially break down into, okay, I know that there is a strong chance that the market is going to reverse on the day. If it is going to reverse on the day, what are the signals that I'm looking for? What are the plays I'm going to be looking for to position myself to trade this reversal day based upon this hammer pattern that I've seen on the charts. So a hanging man is essentially the opposite of a hammer. It assumes existing uptrends. It may mark the end of that uptrend. It basically signals that bulls are losing control of this trend in the market, and it pertains to a bearish reversal. So again, a hanging man is essentially the opposite of what we're looking for. So let's say, for example, the market opens down here, it trades up, and then we start to experience these reversal patterns, these hanging man reversal patterns. That's a signal that the market is very likely going to come back to where it started, right? So when we're looking for these types of hanging man signals where these type of patterns in the individual candles present to us opportunities and signals that the market is very likely exhausted out of buyers, and that the bears are going to be coming into the markets to pull the price back down. So again, here's another example with Microsoft. As we can see here, the price is trending up. So the price is moving in this direction, and then we get one of these candles here, and then the price pulls back down here, right? As you can see in this particular example, I want to make note out of this because it's very important, is that you guys can see in this particular case that pullback here was very minimal, right? As the market still continued to go higher, and reach this particular level up here. Right? And so, yes, it is a signal of a reversal, but the reversal in the signal didn't last very long. In this particular case, we are looking at these individual candles from a 1 day's perspective. And as we can see here, this price pulled back within this range for about I would say 1, 2, 3, 4, 5, so 5 day period where it just pulled back below this range area right here, and then it evidently broke higher and made a new high and went up here. So as we can see, this even though it signals to the markets that buyers have been exhausted, it doesn't give us 100% of a clear signal that the market is going to be downtrending for the next 3 days, 4 days, 2 weeks, whatever. Right. So it's important to know that it does signal a reversal in the markets, but at the same time, how we set ourselves up to trade the markets, especially within the Toro challenge, is that we are only interested in using this information from a daily candle to help us intraday the next trading period. Meaning that how do we take this candle's information and then use this information to help us set up our bias for the next trading day. Okay, so here's an example of a shooting star. Shooting stars is very similar to a hammer or a hanging man. It essentially represents the same information. I put this up here is because, again, you guys may or may not have come across a lot of these individual candles and the names for them. There are a lot of names for these candles, and they essentially represent the same thing. So, a lot of times, you may hear, different names for common patterns or individual signals that you may have already be aware of, right? And so again, here is just another signal of a morning star, or a hammer, right? It essentially signals the same thing here in the sense that the market is going in one direction, and then the market has exhausted in that sense, and that all the buyers are essentially taking profits, and you're starting to see exiting of the long positions. And when you exit the markets from your long positions, you're selling. So as you sell in the markets, it causes downward pressure within the prices, causing that to go lower. So that's how you see these types of reversals. Okay. Any questions so far, guys, about the individual candles from the hanging mans, the shooting stars, and the hammers? Yes. No. Perfect. Anybody else? No. Okay. So dojis. Dojis are essential candles that they open and close are about equal to one another. Right. These essentially suggest that there's a balance of buying and selling taking place in the market, and it may indicate that a trend is weakening. It may suggest a reversal from that level as well. So there are several different types of dojis here that we can take a look at. The first one we have here is the long-legged doji. The next one we have is a dragonfly. Then we have our gravestone, and then lastly our four-price dojis. Okay. Again, you may have seen these being referred to by a different name, but these are the names that I will be referring to these. Okay, so a long-legged doji essentially has a very long wick. The wick length are roughly equal, and they imply a price. They imply a great amount of indecision within the market. So as you can see here, what this basically means is that the opening. Sorry, so the open and the close has essentially remained at a consistent price, right? And then the market has reached a high up here and a low down here, but then it revert back. So you can say the market, let's say for example, the market opened here, right? And then it went up all the way up to here, and then it went back down to here, and then it came back to here and it closed. right? That's usually a strong sign of a lot of indecision within the price actions in the market, right? And this usually is a very strong sign that the market is indecisive on which direction it wants to go, and it needs more information, more price action to take place in order for it to come up with a confirmed decision on the trends in the market. So here's another example. In this particular case here, right, as we can see, the market price went down here, and then the price of that exhausted, and then buyers came back and caused and pushed that price back up. Right. I usually love seeing these candles when I'm trading in the markets. When again, here's another good example on this particular chart alone. Right. As we can see here, when the price becomes indecisive from after being pushed in one direction, right, you usually get a pullback after it's taken place, right? And so again, these candles, they have a lot more meaning when you see them on a daily chart, right? So if you're analyzing charts and going through your charts overnight, and doing your homework, and you come across a particular ticker symbol that has this type of trading day in the morning, and you want to kind of predict what this particular symbol will do the following day. A lot of times when you see this during the day, right, or when you're analyzing at night and you're seeing this particular candle on a daily perspective, the following day you can see the opposite taking place within the markets, right? So over here in this particular example, the market price. So the market price over here went from up, and then the buyers exhausted, and then it went down. Whereas over here in this example, the buyers were selling the price down, 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 and it exhausted, and then the buyers came, sorry, the sellers sold the price, it went down and it became exhausted, and then the buyers came back and bought this back up. Okay, so these are very strong signals when you see them on the dailies. Use them to your advantage when you're analyzing charts from a larger time frame. Okay, dragonfly dojis. They have extremely long. They have an extremely long lower wick, virtually no upper wick at all. They suggest sellers dominated at first, but then buyers pushed this back up. So this is a very strong sign of a reversal after selling. So let's say, for example, if sellers in the markets try to sell this particular product or this particular symbol down, right? What basically means is that the market opened here in this particular area. Sellers try to sell this back down again, down to here, right? And then buyers came in here, and they pushed that price back up to where it opened. Right. And this, on a daily's perspective, is again a usually strong sign that the market has saw enough enough selling, and that buyers are likely to come back in and start buying up the price again. So the gravestone is essentially the opposite of the dragonfly. The gravestone has a very long upper wick, virtually no lower wick at all. It suggests that buyers were dominant at first, but then sellers came in and pushed it back down. So the opposite scenario in this particular case. And when you're analyzing charts and you see prices trending upwards, followed by one of these candles right here, this is a very strong sign that the market is about to come off. Right, so it becomes very important for you to understand this type of pattern, especially again on a longer time frame. Okay, and the four price, so all four price components are roughly equal. This tends to happen in low liquidity, so this is very rare to see, especially in all the blue chip stocks that we trade. When we're trading in shares in the Toro's allowable symbols, very rarely will we ever see basically a candle that's like this, right, where the opening price is is here, The closing price is here and there's no traded action at all. This typically happens for stocks that are like penny stocks, no name stocks. You'll see patterns like this. It also may happen during times of very low liquidity. If any of you were ever trading like Forex or futures contracts or anything like that, this type of candle, you may see it at like 3, 4 a.m. in the morning, 12 a.m. in the morning. You may see some candles like this. If you're trading cryptos, you may see some candles like this. But for the most part, all the symbols that we see in the allowable symbols offered in the Toro Challenge, this is very, very rare to come by. Okay, so evenings, morning stars, a series of three candles may indicate that a trend is about to reverse. So now that we've learned a little bit more about individual candles, now we're going to start learning about the meanings of several candles placed together. So before we move on, I just want to stop for a minute here and say, do you guys have any questions so far? Please type them in the chat box if you do. No? Okay, so moving forward. Okay, so morning stars. Um, Pattern consisting of three candles. First is usually a large bear candle. The middle is a small body candle, which can be a buying candle or a selling candle. And then the last one is followed by a very large bull candle, which indicates that a bullish reversal pattern is about to take place. Right, so that looks something like this. Right, so you have your very large red candle first, followed by a small middle candle, and then followed by your last candle with conviction showing you that the market is about to reverse. Right, and so as you can see here, the third closes near the center of the first. The third opens higher than the middle, which is very, very important for when you're trying to assess a morning star. And the middle closes lower than the first. All right, so I think out of this, the two key takeaways from here would be to understand that this here, the opening price, oops, the opening price here is higher than this price, right? And that the closing price has to be at least within this particular range of the first candle. Right, so that's the most important takeaway from this. And the again, as I mentioned earlier, this is a very strong signal that the price action went from down, right, and now it's ready to reverse and go back up higher. So when you see a series of candles like this is usually a strong sign that the markets are about to reverse. Okay, so here is the morning star, another example of the morning star, except in this particular case, this candle here is red rather than green, right? And again, the same information can be taken from this. It's still a bull reversal in the sense that the prices went down, and now the price was more likely to go back up. Okay, but this is the only difference here is that that middle candle in this particular case is red rather than green. So here is an example of the Morningstar pattern. So as you can see here in the first candle, in the first red candle here, you can see that the market has a very strong selling pressure. And then as we can see here, this is followed by, as I mentioned earlier, our dojis, one of our doji candles, right? A very strong sign of a reversal pattern. This is why I really like this particular candle. I'm a big fan of this when you see this in the pattern of a daily chart, right? So when you see something like this, is a very strong sign of reversal. And then again, that's usually followed by the following day with a lot of buying, okay? Now, again, take note of this particular chart where we see a lot of these small candles. This is why I always say it's always open to interpretation, and that we must use our own caution, because technicals can be very subjective to how one person views this particular chart and this particular pattern. Right. And so we always kind of like have to manage our risk. Although seeing something like this gives us a sense of what the market is trying to do, we always have to manage our risk when we day trade and use discretionary caution. So even though we see a reversal pattern taking place, we are more likely to be biased to the long side when we prepare to trade the following day. However, just because the previous day gave us a doji candle, which represents a reversal pattern, doesn't mean we are going to get into the market today willy-nilly without any form of proper risk management, and just say, just because yesterday's doji candle represents a reversal today, I'm going to be going long at whatever price that I want. And that's a bad way to position yourself to trade. You always must exercise risk management when trading, and it doesn't matter how much of a signal or how much a confirmation you have of on any particular trade. So evening stars is the opposite of the morning star. The conditions are reverse, and it indicates a bear signal. So again, the evening star here, you have your three candle pattern, right? Your middle candle is very important, and then your last candle has to be a red candle. And again, in this particular case, this area here on the sorry, so let me redo that again. So this particular area here, in the second candle, the closing price, right, has to align with the opening price of the third candle, right? And the third candle, the body here, can be within this range here of the green candle for it to be a nice little morning star. Okay. Again, the opposite here is taking place. The only difference between this evening star and the previous evening star is that this middle candle here is represented in green rather than in red. So more candlestick patterns. So the following candlestick patterns have 2 to 7 candles. Examples are for long, reversal criteria for shorts. Indicates reversal levels, rejection levels, etc. Okay, so more reliable when combined with indicators, with nearby levels, with momentum weakening or reversing. So reversal bar patterns typically look like this. So you typically have your large red candle followed by a followed by sellers pushing down the price in the next candle, as you can see here, and then that candle gets pushed down, and then buyers come back in and buy that price back up. So what typically happens here is that you have a higher close, right? You also have a long wick, followed by a lower low and a generalized doji followed in that, and that typically is your sign of a reversal. And this is very important, because when you're day trading, right, and you're looking to see when a trend is exhausting. So let's say, for example, if I'm buying Exxon in the morning and the price is going up. It's going up hard and fast in the morning. It's 10:30 right now, and the trend looks like it's exhausting. Right, you're gonna be looking for patterns like this. Right, in this case, you're gonna be looking for patterns that's similar to this to show you that the market is about to get exhausted. Right, and once it gets exhausted, that's when you know that it's about time to get out of your position, or at least take profits in some of your positions. This is one of the key things that a lot of traders do not do, right? And it kills me to say this, but traders tend to not pocket any money when they are on site. right? And so this is something that we're going to be discussing in some of the later classes when we talk about scaling in and scaling out of positions. When you've gotten a price, let's say for example, if you bought into a price, very early in the morning and you're up on side, 40, 50, 60 cents on the stock, right? A lot of times you want to be scaling out of some of your positions, so taking some profits from your positions, right? This always ensures good trading, right? And also ensures that if the price pulls back or reverses on you, you've at least locked in some form of profits rather than getting nothing. All right, so here is an example of, again, Microsoft using a bearish reversal bar pattern. Um, Luke, I'm going to answer that question in 1 second. Just let me finish this slide. So right here, as we can see a bearish reversal pattern with using the several candles right here. So as the price is trading upwards, we are looking for signs of some of these candles here. And again, some of them look very similar to dojis. And when we see something like that, that's usually a very strong sign that the price is about to pull back. Okay, Luke, so here's my take on trailing stops. All right. Trailing stops, what a lot of people fail to do is that they fail to set their trailing stops at the right time, right? Usually, when we get into the market and the price is moving up very fast, right? A lot of times the price will move to another significant traded level. Okay, so once a price is trying to gravitate towards a significant trading level, as we all know, prices don't always go up in one nice long upward movement. There's always pullbacks, right? So you always experience pullbacks like this as the price is moving up, right? What happens with trailing stops is that the moment you are on side on your position, let's say for example you entered here, right? Let's say for example you entered here in your position, okay? Your position is on side, right? You've caught this wave up to this point here, right? Now, if you were to put a trailing stop here as this price is going upwards towards this level right here, right? Your trailing stop also moves and it moves up to, let's say, somewhere around here while the price is trading here, right? The moment this price begins to move back, what's going to happen is that it's going to move back and it's going to be very likely to hit your stop. So instead of making this much profit on the trade, right? You have only made this much profit because the price pulled back to this level and then hit your stop, right? Does that make sense? Right? So this is my take on the trailing stops right here. And yes, I do think trailing stops are good, but you have to be very wary of the situation in which you use your trailing stops. Okay? I'll give you a very good example. Okay? Let's say, for example, we know that there's a very strong level up here. Okay. Actually, let me get rid of all the lines here on this chart. Okay. So let's say, for example, we know that there's a very strong level up here, right? And we want to enter the market. We want to enter the market. Let's say, for example, we enter the market down here, right? And we know that there's a very strong level up there, and that's the price in the markets that we want to get. Right? So if we get long in the markets, as this market is going up and it pulls back, right? It goes up and then it pulls back and then it goes up, right? We want to set our trailing stop after it has hit the level of the target that we want, right? So this would be our profit target number one. This would be our profit target number one, right? After that, this is when we want to use a trailing stop to lock in more profit. So once the market has hit here, we can use our trailing stops and enter our trailing stops after the market is hit here. So once that happens, we can at least lock in more profits. So as our trailing stop begins to move upwards and upwards, as the price pulls back down to here, right, our trailing stop will now begin to start moving upwards here, right? And because we've already locked in our profits, even if our trailing stop will get hit here, which 100% it will get hit because that's essentially the purpose of a trailing stop, is to lock in more profits. Once our trailing stop gets hit here, we have already essentially locked in about 75% of the profits from this trade because we have locked in profits here. And now as the markets came back and hit our trailing stop, we are stopped out of the trade with at least a little bit more profits here. Does that make sense? Okay, perfect. So that's my take on the trailing stops. That's my take on using an arbitrary stops in the first place. As I mentioned last class, that I don't like to use arbitrary stops. If you're sitting in front of your screen and you're able to day trade, there's no need to have like a stop. Once you've entered a position, because what happens is that you are going to be more likely affected psychologically by your stops once the market comes near and closer to your trade. I think it is easier to just manually get yourself out of a position once the market has broken certain levels in which you feel that you were wrong on the trade, right? Trailing stops and automatic stops and using OCO orders are good for times when you cannot be in front of your screen all day. So let's say, for example, you're sitting in front of your screen, trading during the day, and then by some work of God, a Amazon delivery guy comes and rings on your doorbell, and you have to go and sign for a package, and now you're away from your screen for like 5 minutes. That is when I would input a stop loss or some type of OCO or some type of trailing in my open positions in order to protect me for that moment. I cannot be in front of my screen, right? If I'm sitting in front of my screen all day, I can easily and manually manage all of my open positions. Okay, so that's my take on that. Again, I highly encourage you guys to come up with your own forms. So I know some of you may disagree with me and say that trailing stops are a great thing because it allows me to lock in profits. Some of you may say I always use OCO orders because I feel comfortable having a safety net just in case the market does something abruptly and I'm unable to react to it quickly. This is what makes the markets very unique and very exciting, is that everybody can have their own opinions and whatnot. In my opinion, in my experience, using a trailing stop, if you set it too soon, will cause you to miss out on the trends in the moves because the market will always pull back. And if your trailing stop is too tight, the markets will pull back, hit your trailing stop. You'll be taken out of the trade with a minimal profits, and more likely than not, as the trend continues to move in the direction that you have betted on, you're just gonna sit there and be like, oh fuck, my trailing stop just took me out of my position. Now I'm very mad, frustrated. I want a revenge trade. I want to chase a price. I want to get back into the markets. That type of behavior is more likely to take place when you get exit out of a trade too soon because of a trailing stop. Okay, I've also seen times in the markets in which, having an arbitrary stop loss, as soon as you enter the price, and then the market comes down, hits your stop, and then reverses right there. And if only you didn't have the stop, and if only you would have, watched the market played out around that particular level, you could have at least still be in the trade and still be able to make that decision yourself on whether or not you would have thrown in the towel and got out of the trade, or you would have stayed in the trade and endure being offside a little bit more. All right. So moving forward, key reversals, eclipse. So an eclipse essentially represents two candles, one being larger than the other. So this is an eclipse. So you have your first candle here represented by your second candle, which is much, much larger and essentially eclipses that candle. So closes above the highs, opens below the lows. That's what essentially represents an eclipse. And here you can see an eclipse is usually a signal that more trading action is about to take place, more volatility is about to take place, as you can see here by these candles as they get larger and larger and larger. Exhaustion bar. So an exhaustion bar here represents a gap in the prices. So this here is your first candle, and then you have a large gap in the prices, and then that is followed by your second candle where the market opens. So it has a gap down, reverses direction. You see a fat body with a lot of volume. Right. So this here is very, very indicative in stock trading. So when you see this information in stocks, right, this is usually a really strong sign that the market is about to experience more buying or selling taking place. So as you can see here in this particular example, you have your previous day here followed by your gap day, and then that's increase in volume taking place right here causing that to gap down, and then you see the additional selling followed by an extremely large um, price volatility range right here. So pin bar. So pin bars and dojis. Here we are. So near the POC, we have a reverse in the direction and a long wick. So right here we can see something like this. This usually kills me when I see something like this because you typically have what is referred to as a point of control, which we will discuss this in market profile, right? And this is usually a level that's being respected, and you have a lot of action taking place here, right? And then you have this wick that may suggest that the price is about to break, but then it comes back right away. So this is what we call like a false breakout. It usually happens quite a bit when you're trading markets that are highly institutionally traded. So you have a lot of bank money trading in these markets, and it causes that to happen. Two bar reversal. So two bar reversal essentially represents two strong bars, reverses direction, and not necessarily an eclipse in the price. Next, we have our inside bars. So our inside bars represent a consolidation in prices. So this is key here in the inside bar is that we have the consolidation in prices. It's almost kind of like an eclipse. You can see a lower high and a higher low and a consolidation of volatility. So this is very important when we're looking for wedge patterns. So I'm pretty sure you guys have seen wedge patterns in the markets before. If you haven't, this will be a topic of our next class. But when you see something like this taking place in the markets, right, something very similar to this here, where the price is essentially consolidating, this is a very strong signal in the market for any particular price that in this general area, the price is about to break out in one direction or the other, right? And typically, more so than not, if we have a bear flag pattern taking place, so let's say, for example, the market is coming down from here, right? And then forming this type of pattern, this will lead to a breakout in the downside. So the market is more likely to break out in this direction. Whereas, whereas in the opposite scenario, we see the price is coming up from here. So coming up from this direction, right? So we have a bull trend and the market price is going from the bottom up, right? And then we experience consolidation in prices where we see the candles are experiencing lower highs and higher lows, and there's a consolidation taking place. More likely than not, the price is going to consolidate and break out to the upside. Right, so these are very strong technical patterns, especially these inside bars because they work very, very well for when we're day trading the markets. When we try to anticipate a breakout in the markets, these type of things happen quite a bit. And so it's very important to look for these type of patterns to help us get a better sense of what is going on in the markets and how we position ourselves in the markets, right? So on a particular example like this, I have a question for you guys. On a particular example like this, okay? Let's say the price is going down here and this is a bear flag pattern, right? And there's a strong chance that the price is going to break out and come to the downside. Where are you going to be entering this trade? Are you going to be entering this trade here after the price is broken out? Are you going to be entering the trade here, anticipating the breakout, or are you going to be entering the trade here while the market is still consolidating? Um, Luke, since you seem to be very responsive, more so than some of the other audiences, can you tell me where are you most likely going to be entering your positions in the market? Where you place the first square? Okay. Guys, anybody else wanna get in on this? Eric, Khalid, um, El Riviera, Rohi, anybody? Anybody, guys? Give you one more minute. Actually, there's a nice little feature here. So let's say this is ABC. Okay. B. Eric says B. Anybody? Anybody else? B. Luke, are you changing to C? Oh no, Luke, you've always been in C. Okay, okay. And Khaled says A. All right, guys. So guys, um, the answer to this question would be this square here. The answer to this question would be this square here. Why is this? Now I'll explain. Why is this? Because as the price is consolidating, right, for good risk management, we want to be anticipating a breakout. So usually this is very indicative of a breakout trade, right? And in a breakout trade like this, we want to, for good risk management's sake, anticipate that the price is going to come down. So we want to be entering our orders here, anticipating that the price is going to break to the downside. Why is that? Is because there are established levels here. So this level here is higher than the level that we entered. This level here is higher than the next level that we entered. And so our risk zone, what we're risking is this much. We are risking this much in the markets when we enter this position. So 1 second here. So this is our risk area from this level to this level here. So from where we entered in our price to the first orange line and the second orange line that's above our entry price, that is our risk. So if we are wrong on this breakout, our risk is minimal, right? But if we are right in anticipating this, we will catch this entire move we will catch this entire move all the way to the downside, right? And so this is a technique when you're trading in the markets, right? You always have to anticipate the moves, okay? Luke, when you're trading the markets, especially when you're trading a breakout formation, you don't want to see the breakout happen and then enter the markets, because at that point, Luke, down here, the market has already moved, right? Because the market has already moved, your entry price will not be optimal. So if you were to enter the markets down here, right, your risk buffer will be all of this. So you will be risking this from where you entered, you'll be risking all of these key levels, hoping that they do not break as resistance. Right. So a lot of times it's better to anticipate the moves taking place and then taking a position rather than waiting for the position to break out and then get in, because that leads to chasing. And when you're chasing the markets, that typically leads to downside risk reward. Okay. You also, a lot of times, if you're not fast getting in on the second square in this particular area here, is okay as well. Although it's better to wait for the breakout, wait for the consolidation, and anticipate the breakout to happen, right? Rather than wait for play the consolidation level, because at this rate, even though the odds of a bear flag pattern breaking to the downside is high, you are probably not getting the most optimal price even if you entered here. So it's always better to anticipate rather than to wait for it to happen and then chase a price, or get the price while it's still consolidating within that wedge, right? A lot of times, again, when you're getting in the action on the markets, specifically while the price is consolidating, right? It's very hard to tell if this is still going to continue to consolidate for an extended period of time and then break out. So you may be susceptible to time risk and whatnot. Okay. So I hope that that clears this up for that little exercise on our little breakout. We are going to be discussing this particular strategy and this particular style of trading, breakout tradings and whatnot, much more in depth over the next several slides, or sorry, over the next several modules that we are going to be doing. Okay, is there any is there anything I need to clear up about this, guys? Okay, so if there's nothing that needs to be cleared up about this, we'll just stop it at there. Okay, um, guys, right now, I'm gonna take a little stop for a little break right now. My throat is running really dry, so I'm gonna have to get some water. So let's take a little 5 minute break, and then we're gonna come back and then restart again. Is that all right with everybody? We'll just call it a little, a little water break. Okay, perfect. So we don't have to sit in front of the screen for another hour or so, but I'm gonna take a little break and then we're gonna come back. Let's say we're gonna get back at 1:35. Please do not be late. I will be here then. Okay?
You are now muted. You are now unmuted.
Okay, everybody. Hope you guys all had a nice little 5 minute break. Had your cigarette, had your water, uh, changed diapers if you needed to. We're about to get started again. So, picking on up from where we left off. Um, so this is an example of an inside bar reversal pattern. So as we can see here, you have the price consolidation taking place right here. The price moved down, consolidated, right, and then it reversed back up. So these are little key things that we're looking for when we're trading markets, right? Um, it's very important to understand how these little consolidation patterns take place and how we use this to kind of help us predict which way the market is going, right? Again, you can see even here, over here, you have a consolidation pattern and followed by a much larger candle taking place right next to it, right? Again, we can even see that here, right? Followed by a much larger candle right next to it. Okay, so these are all very strong examples of what we're looking for when we're looking for these consolidation patterns. Okay, so an outside bar is characterized by higher highs, lower lows, and especially true if the previous bar is a doji. All right, so here is an example of that. Again, you have a very small volatile or low volatility candle taking place, and then that's followed by a lot of action taking place during the day, right? During the next day. Sorry about that. And as you can see here, that usually leads to more breakouts or more large trends, right? And it all starts with low price action volatility, and then it's bursting with a lot of action the following candle, and then that leads to more trends in the markets being established and developed. Okay, so now we have our three bar reversal. So the first three bar is bearish, right? The second bar is bearish. The second bar has a lower high. So as we can see over here, right? The second bar has a lower high, as we can see right there, right? The second bar has a lower low, as we can see right there, right? And then the third bar has a higher low. So this here is higher than the previous candle, right? And then the third bar closes above the second bar. So the closing price right here, that right here, is higher than the second candle, right? And so this is usually a strong sign of a three bar reversal when we're trading in the markets, right? And this is very important because when we're trading in the markets, we have to overlay our time frame, right? These time frames here can equate to 1 minute, right? They can be 1 minute, they can be 30 minute, or they can be 1 day, right? It doesn't it's very important that when we look at these candles, right? These candles here can represent different time frames and different information. This information here, when we're looking at this, can really help us when we're trading the markets from a certain time frame, right? So when we're looking at analyzing the markets from a larger time frame, it gives us a sense of what we can expect to do the next day. However, because we're day trading within the Toro challenge, this information here will give us clues as what will happen within the next several candles or the next several minutes when we're trading in the markets. Typically, when I trade in the markets, I'm trading off of 1 minute candles. And so these candles here, when they print, they represent 1 minute information. And I'm looking at these candle information to get a better sense of what's taking place and how I can position myself to capitalize from these markets, right? And using a lot of these intraday reversal candle patterns helps me to get a better sense of what to expect when I enter markets and where I'm supposed to exit a market based upon the information that's being given to me. Right. So, for example, if the market is trending downwards and I'm shorting a position, and then I see a three-bar reversal pattern that's taking place very similar to this is when I would be more likely than not to be exiting my position. Okay. The line of least resistance. So the line of least resistance closes above the highs of 2 days ago. So you can see here, this line of least resistance essentially represents a level within the price, right? And the price is trading below this area here. So below that line here, and then all of a sudden you have extreme volatility within this specific candle here, and then this price action within this candle here represents a strong opening, but then an even stronger closing price in which the closing price closes above the last 2 days price action, right? So again, this is another very strong reversal sign within the markets. Here we have a 3-bar pullback. So our 3-bar pullback is characterized by these 3 bars right here, right, and followed by 1 bar of very strong price action taking place. So this typically happens again when there is a trend in the market. The trend is usually going upwards or downwards, right? And then we begin to see something like this where the bars are printing red, and then that usually leads to a pullback. So, what leads to this? Some key points. It must be in an existing uptrend. That's the first thing. 3 consecutive bearish bars. Note the relative size of the bars. So the price action tends to be very small and very similar to one another from the previous days. And any trend has the retracements. Okay. So again, here is an example that I did several days ago with one of the students.
You are now muted. You are now unmuted.
So I've been trading square with one of the students in the class in the Toro challenge, and what we've noticed is that there was a 3-bar reversal taking place here, and the 3-bar reversal usually leads to a reversal in the pattern, and then the pattern taking place again. So we have action taking place here where the market price was going down, right? And as the price was going down, we saw 3-bar reversal taking place, and then the price reverses itself back up here. So these are the types of things that you want to be looking for when you want to see price action and reversals within the markets. So trends in the markets. So this is very key here, these 3 points, right? And I'm going to be giving you guys a lot of examples here. So bull trends, bear trends, and ranging prices, right? So we all know that a bull trend market is a market that typically goes up like this. A bear trend market is typically the opposite where the price is going down. And a ranging market is typically going sideways as so. Right? And these days typically have different names too, right? So in a bull trend market, we often refer to this as a trend day, right? In terms of market profile. So I'm just gonna write this out over here so you guys can see this. That's referred to as a trend day. This here is also referred to as a trend day. And then over the next couple of days, um, we're going to learn about reversal days. So there's trend days where the market open drives and drives in one direction, and then there's days where the market experiences an open drive reverse, which is essentially the market taking the initial opening, so the initial 15-30 minute opening where there has a lot of volatile action, and in an open reversal day, you'll see something like this taking place. right? So this is something that you'll see that's very common in open drive reversal. So the market will go up in one direction, and then it will fake out and reverse back down to the lows, right? In a typical open drive day, the market will just go in one direction and drive in that one direction. Right. The last day type that we have in terms of market profile, which is similar to this, is a ranging day. We also call that sideways market days. And in the sideways market days, you'll have the initial opening establish a high, and then it'll establish a low, and then the price for the rest of the day will be confined between the highs of the days and the lows of the days. So the price action will essentially just bounce between these levels right here, and they can close here, or it could close somewhere down at the lows, or it could close some down at the highs. But that is what we call a sideways ranging day, a ranging market, where the price is ambivalent. So there's not really that much direction within the markets. So drawing lines, this is something that I'm gonna need you to do for your homework today. All of you, hopefully, you guys are participating, right? Drawing lines because it becomes very important when we're drawing lines to use specific levels as reference points, specific price levels in the candles as reference points, so that we can connect significant points together to draw strong lines and strong levels. Okay, so drawing lines, connecting significant points together becomes key. Examples will be the relative highs and lows, any gaps, average price within the price of the stock that you're looking at. In addition to that, we have to understand that drawing levels is a combination of an art and a science. So here is an example of Apple in which lines are drawn on this particular chart for you. So as we can see here, Apple is experiencing an uptrend, and we can tell that this is a very strong uptrend because of points that are being hit right here and right here that give us clues as to where the price is likely to bounce and where the price is supported in the trend, right? In addition to this, we can also see to the downside, we can see that the price also is supported to the downside through here and here, right? And so this becomes very important to understand how to connect points of references together to give us very strong information about when the price is going up, when the price is going down, how we position ourselves to look at these trend lines as levels to be used for when we're referencing our trades. One last point I want to mention out here is that if you take a look up here, this represents 1 day. And a lot of times when you're analyzing charts, when you're drawing lines, you should always do it from a larger time frame going backwards. So it's important to do like a 1 day. Yeah, sorry, well, that's not the greatest, but we like to typically analyze charts, especially from a technical analysis perspective, analyze larger time frames first. So we go from 1 day. I like to use 4 hours as well, right? From there, you can go down to 1 hour, from 1 hour to 30 minutes, um, and then so on and so forth. But remember, even though we are drawing our lines and our levels from a larger time frame, right? When we are day trading typically takes place during 9:30 to 4 p.m. And so we are only going to see maybe about 600, 700 candles throughout the day if we're looking at a 1 minute candle. So we can use these large time frames as reference points to help us set up levels which we can use as areas of interest for where we want to enter the markets, where we want to exit the markets, However, when we're actually trading and day trading, it's better to use small time frames such as like 1 minute, 3 minute. So that's supposed to be a 3 minute, or even 5 minute when we're looking at the charts to trade during the day. Okay, so does that make sense, guys? When we're drawing technical levels and technical patterns, we want to get a macro view of the chart, right? So we want to see the chart from the largest time frame possible. That's where we want to start, drawing levels and whatnot in the markets to get a better sense of what's going on in the markets. But then when we're trading the markets, we have these levels on our charts as reference points, and then we look into much smaller time frame for when we want to enter the markets. Because when we're entering the markets, we want to make sure we enter the markets with the most optimal price possible. Right, and the most optimal price possible can usually be seen in your small time frames, giving you a better chance to get the best price. Okay, so several key things here, as we can see over here. Over here, we can see a very strong level with the markets. In this particular case, it's on Microsoft, so we can see that this is a very strong level right here. This level acted as a resistance for when price was going up, and it continued to act as resistance when price was going up, right? And as the price is going up, going up, going up, these levels of resistance finally cracked, and this was broken, as we can see here, which was broken, and then the price moved higher. As the price moved higher, when it pulls back, where does it pull back to, guys? It pulls back into a resistance level. So you can see here the first resistance level and the second resistance level has now become the support level for when the markets broke those resistance and pulled back. So it's very important to understand this concept of support and resistance levels when we're trading in the markets, because these support and resistance levels will give us a very, very strong sense of where we can set our profit targets and our stop losses, right? So, for a very good example of this particular trade, if we go here, if we go here onto this particular trade, we can see that if we are anticipating a breakout, right, and the breakout we are anticipating, because we know the market is in essence moving upwards, right, we want to be bullish. And as the price is consolidating here, we want to anticipate that this general level up here is going to be tested and is going to break. So again, in a scenario like this, like back to my first question where I asked you guys, in a consolidating period like this, you want to be anticipating this. So you want to be buying somewhere around here. That is where you want to be entering the markets. And as the market goes up and tests these levels right here, that resistance level, and once it breaks, right, you want to be positioning yourselves to exit and take profits right around the breakout, somewhere around up here once the market has moved. Why? Why don't I like using trailing stops, and why I don't like holding on to a trades and not scaling out is because this always happens in the markets. You have the price pulling back to that support, right? So if you have a trailing stop and your trailing stop carries you to that line of support resistance there, right? And instead of taking profits at that first circle up there on your profit target, you allow your trailing stop to continue to play. What will happen is that as the market pulls back, it will hit your trailing stop. And instead of you making that full move on the trade, you've only made money on half of that trade, right? So that is going to become a very key component to understanding where to trade and how to set up your trades properly, right? Is that when we understand that supports becomes resistance and resistance becomes support, we can position ourselves to trade these markets and anticipate where the price is likely to get back. Again, in this example, If we know the price is going to come to here, test this level here and break it, right? And break it. Once it breaks it, it's going to do another wave or another move up. As that move pulls back, we could have exited our position here, anticipated the move to pull back, where it is anticipated to pull back into resistance level, and then again enter a new position around here for a new long position, waiting for the price and doing another trade, a second trade up here. Right? Does that make sense, Luke? Perfect, perfect. Okay, so some of the other guys don't seem to be very responsive, so I guess it's just me talking with you, Luke. So hopefully you don't mind that too much. There's more one-on-one in that case. Okay, one last thing I want to mention about this is that back earlier I said that technicals typically work better together. Oh, thank you for joining us, Riviera. Right. Back earlier, I mentioned that technical indicators typically work better when they are combined with chart patterns and whatnot. So one of the key things I want to mention here is that specifically in this scenario here, we can see that our our support resistance level has been given more merit because our moving average is now traded here too. So you can see that moving average line as it's going up, where it's right as the price came back from breaking the resistance. That resistance acts as support, and you can begin to see additional confirmation being shown on this particular example based upon the moving average as well. So the moving average also acts as a dynamic support resistance level. It's very important to understand this when you're trading the markets. I know a lot of people like using moving averages, but have difficulty utilizing moving averages to help them trade or help them set up trades. And so I have never been able to profitably make money in the markets using a moving average technique. In my trading style, particularly for me, moving averages essentially acts as a dynamic support and resistance indicator that confirms my levels in which the price will bounce or the price will reverse from based upon the information of past candles used in the moving averages. Okay, any questions about the moving averages, guys? No? Okay, perfect. So here again is more examples of lines being drawn. As you can see specifically in this case, all right, this here is an example of the S&P 500. We all know the S&P 500 has been on an absolute tear since Donald Trump took office, right? And ever since then, it has been going up, but it has experienced these periods of wild swings and volatilities within the markets, right? And if we are drawing our lines properly, we can see that again, even this here is a consolidation within this move. And those consolidations, again, in a bull pattern, are more likely to break to the upside. So as you can see here, when the price is going up like this, and we experience this similar pattern, which is referred to as a bull flag, we can typically see that the pattern here is more likely to break up to the upside. So you can see the price is still moving forward and moving upwards, right? So this is going to be something that I'm going to ask all of you guys to do for homework is to take a look at some of the ticker symbols that you're looking at, get onto a large time frame, draw some levels, draw some channels, draw some lines and whatnot, and then we'll take a look at them for next class. So defining trends. So in bull trend markets, we're typically looking for higher highs, higher lows, positive slope lines, increased slope of the trend lines as well. These are all very strong signs of a healthy bull trend. In a bear trend, we're looking for lower highs, lower lows, a negative slope of the trend, decreasing slope of the trend. These are all signs of a bear trend moving down the markets. Okay, so in an uptrend market, so this is what we typically see in an uptrending market where you see higher highs being established in the markets. So this level here is lower than this level here in the highs as the price is moving forward. And the lows here are lower than the previous levels, right? And so this is established as a sequence of higher highs and higher lows in the markets, which is very typical of a trending market, which moves in prices going upwards. All right. So here is a definite bull trend. We can see if anybody has been trading the Dow Jones ETF, or any of the stocks within the Dow Jones. We can see here that a very strong trend has been taking place since 2012. This trend here is basically when the Federal Reserve came out with their quantitative easing program and easy money program by cutting interest rates and flooding the markets with extra money. All that extra money essentially went into the stock market, and since then we have had an extreme bull run, possibly one of the longest in history. And so trading in this particular environment is not very difficult. I mean, in this particular environment, we're just looking for buying the dip strategies in which every time we see a large volatile movement in the markets, we use that as opportunities to buy the dip. A very good example is if any of you have been following Facebook today wiped out about $120 billion in value because of their earnings call. Facebook users have been decreasing for the first time, and as such, the markets tanked Facebook by 20%. I believe Facebook went from $200 and 20, sorry, 220. I'm mistaking that. $220 to about $100 and 80 some change, give or take. The market is still trading today. Anyways, my point is that because we are still in a bull market environment, um, from an investment perspective, you can use these large dips as buying opportunities. Although this is more of a buying strategy because you're buying and holding on to Facebook for a long period of time, it may not be applicable with the day trading strategies. But a lot of times, a lot of these large moves in the markets offer up intraday opportunities, but they also offer up investment opportunities as well. And so when you have large moves like this, from an investment perspective, if you have a portfolio, you can start adding some of these stocks into your portfolio if you missed out on the rise in the price. If not, if you're monitoring this just to flip these shares on a daily basis, again, this is what we're mostly going to be talking about, recognizing these intraday patterns so that we can take advantage of the price discrepancies. I just wanted to throw that out there because Facebook was a very good example of a stock that got hit really, really hard today. And so I believe in the next several days, possibly in the next several weeks, we are going to see very good buying opportunities coming in Facebook. So I'll probably be actively trading Facebook and possibly even actively invest in some of Facebook as well for the long haul. All right, so here we have a downtrending market, and in downtrending markets, we see the price move lower, makes lower highs established by lower lows in all of these particular cases. And the key here is that these levels here are lower than the previous, right? And so this is how we establish downtrends in the markets when we're trading. And obviously range bound markets. So we have a very consistent price level in a range bound markets. And in range bound markets, the price will just essentially bounce off of these levels going up and down. And in this scenario here, in range bound markets, right? A question for you guys: when you establish a range bound market, right? Where are you more likely to enter if you want to execute a trade? Here, here, or here? So let's do this. Let's make this one. So that's one, that's two, and that's three. All right. So question for you guys: where are you most likely to enter? In one, two, or three, or we can even say in A, B, or C. Two, one, one. Luke, you're switching from two to one. Riviera, are you there? Khaled, Eric, you guys there? Were you switching from two to one in this particular scenario? Yes, no. Yes. Okay, so to answer this question, the answer is two. Because again, the issue here, Luke, is that the price we know has established a range bound market, right? So in a range bound market, the price will be unlikely to break below here. So that's the issue with getting into one, is that we may not get filled. Okay, that's the issue with choosing number one, is that you may not get filled. And even then, the issue with choosing number one is that if this level here breaks, so Luke, if this level here breaks, like the price comes down and breaks below this level here in one, we are no longer in a range bound market, right? Unless we see like one of these candles where, if you remember the dragonflies candles, where it looks something like this, where we have a very long wick, right? If it breaks down and we see something like this, a candle that's like this, then yes, one would apply. But that's typically very rare, and a lot of times people get shaken out because what most traders will see is that the lower bound of the range has been broken, and so the market will begin to tilt to the sell side, right? The problem with choosing number three as an answer is that the market has already moved up quite a bit, and so if we were to get in here, our risk would be represented by this large red box, right? And so again, this would be more like we are chasing the price. So like if we miss the price, if we miss the boat, the market's moving too fast, we're too slow to react, and we hit number three, then that's where the price will be more likely, where we will be more likely to get into the markets, and the price would have gone already. Okay, so that's the issue with number three, is that at this point, our risk reward on the trade may not be as optimal. Okay. Now, granted, if the range is much bigger, right, and our and three is very similar or merges with two in that sense, in that general area, then yes, it will be applicable. But in this scenario here, number two is where you want to be, right? Because entering number two is twofolds. Number one, here we have anticipated that the market is going to bounce. So we anticipated that the market is going to do this and then come back up right away. So we have anticipated that this market is trading in a range and that it's going to bounce right away, right? And secondly, if we are wrong by entering in number two here, our risk reward, our risk is much smaller because if it breaks that green line, we are wrong on the trade, then we get out. But if we're right, entering where we are, we can stand to capitalize on all of this move. So this would be more of like a 5 to 1 risk reward ratio. Okay. All right. So building upon last class's knowledge about market orders, Luke, I want to challenge you in this. In this particular scenario, would you be using a market order or a limit order? And you guys remember the difference between a market order and a limit order, right? A market order gets you in the market right away. A limit order is a price you select and then you wait for it. Absolutely correct. Limit order is the one that you want to use, right? Because again, if we are anticipating the price to come down here and then bounce, what we can do is we can set a limit order here. So we put in a limit, our L our LMT order here, right? Somewhere around here, we wait for the price to come down, hit our limit order, right? And then we expect it to reverse. If it doesn't do what we expect and reverse and continues to break lower, we exit the trade with a very small loss. But if the trade is supposed to play out as to the way we anticipated, our limit order will get filled at the best price possible. And then we anticipate that the market is going to reverse. And then we stand to make from the bottom bound here back up to the top bound here, which is an optimal risk reward or a great trade in this case. How do you determine your stop in value? That's a very good question, right? Your stop in value pertains to how much shares you have on, right? Again, remember in the first class when we discussed the Toro challenge, right? So in the Toro challenge, the max we can lose on a day is 500. That's our total max daily loss, right? It's 500. So on a trade like this, right? Let's say for example, we put on 200 shares, right? We put on 200 shares, right? And right. So 450 is our loss. It's like our we don't want to use the Toro's loss as our arbitrary. We want to set in our own loss at $450 so that we can have a nice little buffer zone so that the auto flatter does not take us out of the trade, right? You never want the Trader2B's auto flatter to be your risk management system, right? So we want to set that. But anyways, if our loss is let's say $450 instead of 500, right? What we want to do is we want to break that down into two trades or three trades. So that basically comes to the point where we can risk. So we can risk about, let's say, $120 on the trade, right? We can risk about $120 on the trade. And so for simplicity's sake, let's say, for example, if we put on 200 shares, right? If we put on 200 shares of, let's say, MU, right? And MU is trading at let's say $55 per share, right? So just some basic math here. If we were to buy in this particular area, let's say that's $55. We were to buy in this particular area. We bought 200 shares, right? So let's say every 10-cent move on the on MU would essentially. Just give me one second here
You are
while I
now muted.
pull up. Just give me
You are
one
now
second here while I
unmuted.
pull out the calculator.
You are now muted.
Okay, so let's say, sorry about that. So I had to pull out the calculator here. So if MU is trading at $55 and the price at 200 shares goes against us 25 cents, right? That would essentially equate to about a $50 loss on that share. And if we are willing to risk about $120 on this trade, this will allow us to give a much larger buffer zone. So we can risk up to 50 cents on the share, right? And so that will still allow us to remain within our own personal risk management per trade of 120 shares. Oops.
You are
Oh,
now unmuted.
sorry about that. Sorry about that. So as I was saying earlier, if we are to use this level as our entry price and the price that we entered is $55, right? For every 10 cents that we lose would equate to about $20, right? And so if we are offside by about 50 cents, right, that would equate to $100. So let me change that. So in this particular trade, if we are offside by 50 cents on this trade, we would be offside by $100. So sorry, so let's get rid of this. This is not right. So we would be offside $100 if we are holding this trade 50 cents underwater, right? And so when we take a look at our risk reward, if this particular zone here that we entered, this particular zone here that we entered, which gives us the optimal risk reward, if this particular zone here, let's say from where we entered to where we are willing to throw in the trade, is about a 50-cent zone, that means our upside reward has to be at least three times that big. So that has to be at least $1.50 to the upside, right? And so if we have on 200 shares and we entered at $55 and we're offside by about 50 cents, then we'd be down about $100 on our trade. But if we're right, we would be we would be up $300 on our trade, right? So that's how we determine our stop loss in terms of value. We want to break down our trades into how much can I risk in total on the day. Once you understand that you can risk $450 on the day, we want to break that down into how much trades can I put on the day, right? Do I want to trade all of my $450 in one day? Or do I want to trade or do I want to break that into several trades, right? Yes, that's a very good point that you brought up there, because for a stock that's trading within this range, our max loss is set at 35 cents, right? Again, this is just an example that I'm using because I don't have the per max loss sheet up right now. I don't know what is the per max loss set on that. But again, the auto flatter will essentially stop you out if you are offside by more than 35 cents on this particular stock. Okay, but what you want to do is that you want to determine first and foremost. Exactly. So we can use a 30-cent stop, right, for this particular trade. So you want to determine first and foremost, very quickly how much you can risk in terms of if you're offside on that trade, right? So if you're trading a stock that's 50 to $75, the case would be 30 cents. So 30 cents offside is your risk. Your upside has to be at least 90, right, in order for the trade to be worthwhile. From there, we can start looking at, okay, so if I'm 30 cents offside on this trade and I have on 100 shares, well, how much would that equate to in terms of monetary loss? Well, if I'm offside by 30 cents, right, and that equates to a $30 loss on 100 shares, well, if I put on 500 shares for this particular trade and I'm offside by 30 cents, I would be down $150 for this particular trade, right? And then when you look at in the context of how much trades you can put on in a day, $150 would be more than three of your allowable trades. Then you got to start thinking about, okay, maybe this is not a good trade, or maybe I got to scale down my position so that I trade less size. Does that make sense, Luke? Okay, so I'm gonna come up with more examples of this to make sure that it's absolutely clear for you. But just to move forward, I'm gonna move forward and finish all of this, and I promise you we're gonna come back to this so that you can get a much clearer example of this. Okay? Okay, so here's an example of a sideways ranging market. As we can see here, the price is ranging sideways and then it eventually broke out. So as we can see here, a lot of these type of things will happen when we're trading in markets that are very volatile. You'll have what we call overshoots or undershoots, where the market breaks above the range only to be rejected. And as we mentioned earlier, if we take a look at our dojis or our candles on reversals, we can see that a lot of these pertain to those reversal candles that we were referring to. Okay, so here we have a combination of an uptrend market and a sideways ranging market, as well as a downtrending market, all combined into one. So trading trending markets, bull trends, you're looking to buy dips on bull trends. On bear trends, you're looking to sell rallies. So in this particular scenario here, you want to be looking for anytime the market dips. So as you can see here on bull trends, as the price is going up, right, you want to look for the price to dip down here and then buy it. Again, as the price is going up, you want to look for it to dip and then buy it. You don't want to get caught in the scenario where you know it's a bull trending market and then the moment you see red you start exiting the market because you feel that the scenario has changed or the picture has changed, right? Overall, you want to take a look at the macro picture of things to get a sense of what's happening in the bigger picture. And as things are playing out, you want to ensure that as long as there is no macro change in the markets, then any dips in the market should be viewed as buying dips. So even on trades like this, where the market is going up, right, and the market continues to go up here, the market continues to go up, it finally pulls back, and it pulls back here, and that was a buying dip. Even here, in these areas, were referred to as buying dips because, again, even though the market is now going sideways, as long as there is no macro change in the markets, the fundamentals should suggest that the market should continue to move upwards. Trading range bound market. So in a range bound market, you're going to look for reversions back to the mean or back to the average. You want to look at buy at the lows, sell at the highs. You want to look for your candlestick patterns and your individual candle patterns that will suggest the market price is beginning to reverse. Okay. Levels. Levels indicate support and resistance. Levels reversals at a level can indicate a change in the trend. Breaking through a level can indicate confirmation of a trend. Longer time duration equals stronger trend. So again, this is what I was referring to when I was talking about these longer term durations. So as we can see down here in the time frame, this is a very long term duration, and so the trend is very much still intact. Okay. Examples of levels. So this is very, very important when you are trading in the markets and using these for levels. So levels can be found at highs and lows of the day. These act as very strong anchor points for where the market will experience additional buying or selling behavior, or they will exhibit reversal behaviors. So look out on an intraday time frame for the highs and lows as key areas. You also want to look at yesterday's closing price as key areas. You want to look at point of controls as key areas. And so a point of control, let's see if I have an example of a point of control here. A point of control is very similar to a sideways ranging market. So if you guys take a look here, right, when you're looking at a market and you're looking at a chart where a lot of the candles are just ranging sideways like this typically refers to as not only a sideways ranging market, but a point of control within the market as well. And so point of controls often act as very strong anchor points for the markets to use as a level, right? And I'll show you more examples of this in the future. Gaps. So gap levels have also been very, very important for understanding um, how to identify proper levels. Gaps usually act as very, very strong points in the markets in which the market will try to reverse. So this is very good for intraday trading. If you have a opening within the markets that is lower or higher than the previous day, a lot of times those gap levels and the vacuum zones there act as very strong anchor points for the markets to come back. And then last but not least, Fibonacci's. Fibonacci's is also something that we're going to be talking about in the next few modules. For those of you who don't know, Fibonacci's is a set of mathematic ratios which, when divided by one another, will provide you with certain key ratio levels out of 100. And these levels out of 100 act as very strong anchor points, which can be used in the markets of trading. Right? And so I will explain this more in depth. So highs and lows. So highs and lows here, the yesterday, the day before, which acts as very strong levels. Past 2 weeks, past week, past month, past year. These are all reference points for which you guys can use as highs and lows levels. So again, here is a very strong example of highs and lows and support and resistance on a daily chart. So as you can see down here with very strong examples of these supports down here at this price, as well as resistance over here. So these levels here act as supports, and then once it is broken, the support becomes resistance. Right. Yesterday's close. So here is an example of yesterday's closing price in which you can see right here the previous closing price from this day here, right? And the gap, so this is referred to as the gap. This is white zone right here between the first candle. This acts as a gap, and you can see here the price comes down, touches the gap level, right, and then bounces from there, and then continues trading. So again, this acts as very, very strong focal point for the markets. Gaps. Gaps can form significant levels, especially at the day level. The upper and lower bounds of the gaps are both significant levels. So here is an example of Apple and gap zones trading in the markets. So as you can see right here, particularly this area here. So you can see the closing price right here, and then the opening price right here, right? And this zone here acts as a gap, right? And we can even see that here as well, acting as a gap. These gap levels here typically act as very strong zones in which one, the markets will try not to trade in this particular area, or two, they will retrace this particular area as shown in this particular example right here of the Power Shares QQQ Trust. Okay, so here again, this is something that I like to trade a lot, and I've made a lot of money trading this. When you're looking at gap zones here, right, the market here in this particular case, bonus for those of you who are able to identify that the market is making a wedge pattern here and is consolidating at the highs here. And because we know that this here acts as a level, a magnet point that pulls the markets, once this level here is broken, Once that is broken, the market will very likely try to fill up this gap and try to head here. And this often leads to very easy trading in which your risk is very low, but your reward is very high when you're able to catch a lot of these movements in the price. Okay, so here is more examples of gaps. As you can see here, in the gap prices. The market gapped here and then opened up here, right? So these are all strong gaps in the prices. And as you can see in this particular example, over the next several trading days, the market does come back and try to refill that gap, that bottom level. Right? And once it gets rejected, it comes back up. Right? So these are very, very good examples of gap trading, right? And trading gaps, especially because we are in the Toro Challenge and we are not allowed to hold positions overnight, especially through the opening of the next day when prices are very likely to gap within the markets. Using these market profile strategies and understanding levels of gaps will help you position yourselves to trade the markets and know where the markets will go or likely go to if you understand how to trade gaps properly. Okay, so in conclusion, guys, learn the candlesticks pattern, the individual candles, as well as a series of candles. They will essentially give you clues on how to position yourselves to trade the day. Understand that support and resistance levels is the most important thing you must understand when it comes to trading, as these price levels will act as pivotal points of interest. Okay, so understand how to identify levels using highs and lows, understand how to identify levels using gaps. We'll talk about identifying levels using Fibonacci's, and we'll also talk about identifying levels on various time frames, right? Also understand that the markets will exhibit three types of intraday trading patterns. So you'll essentially experience trending markets, which is a bull or bear market. You'll essentially experience a reversal market, which is typically a market moving forward and then downwards, and then reversing on the day. So those are we call reversal markets. And then lastly, you have sideways ranging markets. And again, we'll talk more about how to set up trades to trade these type of markets, because this is what you're essentially going to encounter throughout the day. This is what you're going to encounter when you're trading the markets, and it is using the knowledge of these trending markets, the knowledge of the individual candles and the groupings of these candles, and the knowledge of identifying proper support and resistance levels where the markets will be interested in trading, and using these levels and overlaying it with your overlaying it with your knowledge of proper risk reward setups, and entering trades in which, when you're right, you make a lot more than when you lose and when you're wrong. Okay, so I'm gonna leave it at that. Today's class ran a little bit longer than usual, which is typically fine. If you guys have any questions at all, please type them in. I know, Luke, you were not clear with the example of what was the most optimal price or optimal wager to put on a particular trade when we're overlaying with your setup. So I'm going to come up with some examples for you for the next session, and make sure that you absolutely understand this. We are essentially going to be talking about this. We will have an entire module on this when we talk about trade setups. So we will continuously go over this until you absolutely understand it, because it is critical. It is absolutely critical for day trading to know how to properly set up risk reward and know how much to wager based upon the framework that we have to work around. So, if you guys have any questions for me, feel free to just ask me the questions if you're on a microphone. If you're not, type in your question. I'd be more than happy to answer your question. As always, I apologize for last class when I did not send out the module right away. I'm going to take 5 minutes and go have a little breather, and then I'm going to come back and I'm going to send you guys these modules so you can go over them yourselves. If any of you want any recording of today's class so that you can keep it for yourself and watch it later, please let me know, and I'd be more than happy to make that happen. Okay, so I'm gonna disconnect for a second, but I'm still gonna be here. So if you have any questions or anything, I will answer your questions. All right. If not, have a good one, guys. I will see you next class on the next module when we will talk about part two. Always a pleasure. Always a pleasure talking with you guys. And yes, Riviera, I will absolutely send you the recording. Is that your email, Riviera? Your screen name? Oh, Lawrence. Very nice to have you here. Okay, guys. I'm gonna be disconnecting from the microphone, but I will still be on the chat. I still will be on the chat. So if you have any questions, please let me know. I'm gonna send the module and I'll send you guys the recording. We'll figure out a way to do it. One thing though, the issue with the recording right now is that I have this file at almost 1 GB or so, so we may have an issue sending that to you guys. Let me talk to the team. We'll figure out a way to work this out. We may have to put it on YouTube or Vimeo in like a private channel or something like that. But once we figure out the back end issue, I will absolutely let you guys know where you guys can find a copy of it. All right, guys. So I'm gonna be disconnecting from the microphone, but I will still be here. If I don't hear from you, have a good afternoon. I enjoyed today's class. I hope you did too. I hope you learned a lot from today's session. There's still a lot more that we have to do. If you guys can play around with some of the charts, show me some of the lines and the levels, especially the levels, the support and resistance levels on a chart by annotating and drawing lines on charts, and I can give you guys some feedback as to my opinions on the charts and whether or not you are able to identify strong key support and resistance levels. And then I'll take a look at this for you guys for next class. Okay, so I'm signing off. Talk to you guys later. Have a great afternoon.
You are now muted.